In September, vehicle sales accelerated last month, rising by 5.2% month on month. Sales were also more than 22% higher than the same month last year. Join me with more insight into these numbers, Sydney Soundy, Managing Executive at Absa Vehicle and Asset Finance. Sydney, thanks very much for coming in. Of course, you were in a month ago and we were chatting about September's numbers, and there was a few things that influenced those. We had the new emissions tax on vehicles, and we'd also come out of a period of strike activity. Is that all out of the system now?
Steve, it's not totally out of the system. As we indicated also last time, we believe that it will take close on 4 to 6 months to sort out the stock level issues with the dealers.
So the backlog?
So the backlog, yeah. So that is still with us. But as you've seen, there's an improvement. And if you compare the performance in October versus August, it's also around the same sort of numbers that we're seeing in October, which means that the dip that we experienced in September is now corrected as we move into October.
Well, year to date, sales are almost 24% higher than the same 9 months or 10 months of last year. Is that what you'd have expected at the beginning of the year looking forward, or do you think that the strike activity and the vehicles emissions tax has maybe coloured the numbers a little bit?
I think both those factors would have affected the numbers, but we still believe that the initial projections that we had in the beginning of the year will still be realized, if not just short of realizing them at the end of the year because of the strike effects.
Okay, so refresh us, what were your projections for the full year for growth?
Yes.
What number are we looking at? Around 24–25%?
We're looking at a total of about 471 vehicles for the year.
Okay. Light commercial, interestingly enough, up 13.4% month on month, and here we're talking about buckies and things. That's quite a surprising jump.
It is a surprising jump if you look at the month on its own. However, if you look at the year-to-date growth, that is not too big. We're looking at, I think we're looking at 11.6% growth for the year. So in relation to the year-to-date growth, I think it is to be expected. Starting to play a bit of catch-up with the rest of the sector, though. Indeed.
Exports 27,338, and I think we had 12,530 the month before, so more than doubling, and again back down to the strike, isn't it?
Again, back down to that, because if you look at the 3 months before the strike effect, we were looking at exports of about 23,000. We're now at 27,000. So you can see that even in terms of the catch-up from manufacturers, in terms of contractual obligations, that October actually reflects that.
Sydney, how are you seeing the consumer at the moment? Because we've had all of these interest rate cuts. In fact, we had one in September that we chatted about when you came in last time. But it really looks like households are still under pressure.
Households are still under pressure. As you know, even the introduction of the NCA, as well as the tightening of credit lending by banks has put a damper on the numbers. So we still believe that consumers will still be cautious, even despite the fact that interest rates have dropped.
Of course, the NCA is here to stay. So do you think this is going to change the way vehicles are sold and bought forevermore in South Africa, that we're not going to get back to those heady levels of a few years ago?
I think it will, but also, I mean, depending on the growth in the economy, if the economy grows much more into higher levels than we've seen, then we could go back to the previous years. However, I think the focus in terms of protecting the consumer against bad lending, that will remain with us forever. And financial institutions have also lent and have committed to do the same going forward, protect the interest of the consumer.
Because I think we've had interest rates cut by about 600 basis points in the current cycle. Talk that we could have another one next month. Do you think another interest rate cut would make much difference to vehicle sales, that it would give consumers a bit more confidence to go out there and buy a new vehicle?
It's difficult to say. I don't think it will be significant because despite the decrease in the interest rates we've seen in this year, we haven't seen the effect being that impactful. So we expect that, yes, it will buoy a little bit the market, but not to the extent of strong hikes like we've seen before.
Because even if we do have another cut at this month's meeting, it does look like we are getting to the bottom of the cycle. Do you think now's a good time to go and fix your rate if you do want to hedge against higher interest rates going into the future, if you're a bit nervous about that?
I think it is the right time, and we're already seeing very astute consumers doing that. We've seen growth in the fixed rate product, particularly in our financial institutions, and I think it's happening across the board. So it is indeed the right time to fix your rate, so that as rates go up into the future, you're well protected as a consumer.
What sorts of rate would you typically offer at this stage in the cycle?
Well, it depends on the risk assessment of the individual, so it will vary on the basis of the risk that you're dealing with. But on average, I think you're looking at about 2% above prime on average.
Okay, so you're probably going to be paying a percent or a percent and a half more than you would pay if you took it on a variable interest rate.
Yeah, that's on average, because you know, the financial institution covers its own risk in terms of when the interest goes up, but you also have peace of mind up front, and you benefit towards the upcycle. You obviously in the beginning pay for the risk that you're taking on fixing the rate, but as a consumer, over the term of the vehicle, you actually do benefit.
Sydney, how about vehicle affordability? Are we seeing any signs of vehicle prices easing at all? Because we've seen the rand strengthening significantly against the dollar in particular, and surely that must make imported cars and imported components significantly cheaper. Are we seeing that reflected in vehicle prices?
Indeed, it is so. If you look at the vehicle price inflation, second quarter was around 3.9. We're looking at 3% at the third quarter. Obviously, fourth quarter still to come out. So if you look at that, the prices have really been contained at affordable levels, but also in terms of the preference of customers, given the current financial situation, we see a lot of customers opting for affordable entry-level vehicles.
How about second-hand vehicles? I think last year you were seeing 2 second-hand cars, or you're financing 2 second-hand cars for every new car. Are we still seeing a ratio like that?
The ratio has gone down a bit, so we're looking at 1.65 around there, 1.65 used vehicle per one new, which indicates that in terms of the issue we've just been talking about on the new vehicle price inflation, that because of that the difference between new and used vehicles is not that huge. So consumers would rather opt for a new vehicle than a used car in that instance. So in terms of that, the new car ratio benefits.
Sydney, we have to leave it there. Thank you very much for your insights today.